Hi students, let's revise CF and AFM Advanced Capital Budgeting Decisions. Problem 15. Practical question 15. Determine the risk adjusted net present value of the following projects. They have given 3 projects wherein the initial cash outflow is 2,10,000, 1,20,000 and 1 lakh, and the project life is 5 years for all the 3 projects. Annual cash inflow they have given 70,000, 42 and 30,000, and coefficient of variation they have given 1.2, 0.8 and 0.4, and they have given that the company selects the risk adjusted rate of discount on the basis of coefficient of variation. So since we have to find out risk adjusted NPV, for calculating NPV we need discount rates to multiply with the cash inflow, and they have told that company selects the risk adjusted rate of discount based on the coefficient of variation. Now for each coefficient of variation they have given a risk adjusted rate of return. As we have previously seen in our questions, the coefficient of variation is the per rupee risk involved in a project, and the more the risk, the more the risk adjusted rate of return. As a nominal investor, we will expect more returns when the risk is more. So as you can see, when the coefficient of variation increases, the risk adjusted rate also increases. Okay, now they have given for project X the coefficient of variation is 1.2, so we have to take the risk adjusted rate of 16%. Then for project Y it is 0.8, 14%. For project Z it is 0.4, 12%. We have to calculate using this risk adjusted rate. We have to calculate the NPV, and if the NPV is positive, then we can go ahead and accept the project. If it is negative, then we should not accept the project, considering the risk adjusted rate of return for the coefficient of variation, which the per rupee risk involved in these projects. Okay, so going ahead, as we can see in project X, we are getting a positive NPV of 19,180, and in project Y positive NPV of 24,186, and for project Z the NPV is 8,150. So as we can see in all the projects the NPV is positive, so we can go ahead and accept the projects. And the more the risk, the returns are also more. Comparing to that, if we see for project X the risk is 1.2, but the return is just 19,000, and for project Y the risk is 0.8 only, but we got a return of 24,000, and the risk is less in case of project Z, but the return is 8,000. But there are other ways also, because the initial investment is less in this case. In this question they are not asking on the decision whether we should accept or not and all, but we can give on a general basis that since the NPV is positive, considering the risk adjusted rate which the company chosen, if the NPV is positive, we can go ahead and accept the project. That will be a simple answer. Thank you.